Uh, Thank you so much, and I profusely thank the committee of HCC for giving me an opportunity to address this august audience. So, a quick introduction: Nafa Asset Managers. We are a SEBI-registered portfolio management company. We're based in Chennai, Mumbai, and Gurgaon, and we are managing almost 750 to 800 crores of assets, including some advisory assets as well. Uh, when Vignesh actually approached me for this talk, so I was pondering a lot over what really to talk about because markets are close to all-time highs, and there has been a dime a dozen presentations, sectoral presentations, and you have presentations about the Indian macros and so much. I just thought that I'll take a slightly different route and speak about what we think is a very relevant aspect in investing, which is that. Uh, the difference between running a business and equity investing. So basically, in our experience, we come across various clients on a pan-India basis, and a lot of clients in Tamil Nadu as well. So the life cycle of a typical investor is, he or she runs a SME or an MSME business. Then, very hesitantly, they start a small, portfolio management allocation. The allocation in their overall scheme of things will be very, very minimal. So there's a lot of skepticism towards it. And the skepticism, there is more fuel to the fire added to the skepticism because invariably the first or the second year you see zero returns or sometimes even negative returns. Then, you know, uh, they really start doubting their own decisions about investing in the market. Some of them pull out the money, and as the journey continues, by the fourth, fifth, sixth, or seventh year, the market starts doing its magic, and then they start seeing the impact of the compounding which the market has done. Um, then they open up even more and speak about business and how. I mean, they kind of check their performance, the business performance with their portfolio performance, and there's a bit of a variation between what the portfolio has done and their own business has generated, and they come and talk to us. So they look at the portfolio. The portfolio has 30 ideas, 35 ideas. Some of it has done 10 bagger, some of it is down 50%. So you have a combination of so many things happening. So they really want to know what is happening, and uh, then we enter into looking at their existing business, and there's a common pattern which we seem to be finding in the kind of businesses that they were doing, which we thought we can highlight to you. So, I usually take my wife's help to do the presentation and, make the slides slightly more readable. So, this time when she saw the topic self-run business versus equity investing, she herself was shocked. She's saying, you have a very gutsy thing to do. Markets are at an all-time high and you want to talk about self-run versus equity investing. So, good luck. Just a quick comparison in terms of what we are trying to highlight over here. So, in terms of ownership, in a self-run business, obviously you have the full ownership. Vis-a-vis equity, there's a partial ownership. You're a minority shareholder invariably. Your involvement is full time. You're the decision maker for whatever happens in your business. Whereas in equity, whether it's a portfolio or a direct equity or a single stock, the decision making is outsourced to either promoter or a professional or a combination of both. In terms of risk perception, I'm not talking about actual risk, the perception of risk. Invariably, people feel that self-run business, the risk is low, whereas the equity market, the risk is high. And perception of return, obviously, the perception is that the self-run business, the returns are much higher and wealth creation happens sooner vis-a-vis equity, where, the perception is that it's very volatile and there's a, element of lack of control which people feel over equity. In terms of scalability, if you're having, uh, if you have a small MSME plant, there's a view that you can double or triple the capacity, and you can buy out someone, you can make an inorganic pursuit, and so on and so forth. Whereas there is a kind of a inherent bias towards kind of really scaling up your equity portion of your investments. Uh, so no business is linear. There is always a non-linearity element in businesses. So that is true for both equities and self-run business. So whenever the business faces headwinds, uh, in a self-run business, you since you're the decision maker, you can kind of attack the situation and turn around the headwind and get it back on track. Whereas in equity investing, you have to wait. I mean, if you buy a cyclical business at the wrong time, then you have to wait for either you book a loss and move on, or you have to wait for the cycle to turn favorably again, which may even be 10 years, 15 years, etc. Uh, the perception of growth in business, people feel that growth is unlimited. You can keep on growing, whereas in uh, equity investing, there is a fear. They think that the growth will be very limited. So this presentation, basically, there's no particular audience that we are targeting, but ideally, there are many SMEs and MSME owners who might be having 90% of their net worth in their business and maybe 5-10% in equity. He or she is maybe trying to ramp up, thinking about ramping up equity, or there might also be equity investors who over the last 3 years have made phenomenal returns because the index itself has given a 25% plus kind of a CAGR returns. You might, I mean, business opportunities are dime a dozen. So, the grass they feel is always greener on the other side. So one might consider moving some portion of the equity business into some other creative self-run business opportunity. So it's a combination of various aspects. Uh, just a few frequently used definitions, at least in this presentation, not many, just four or five. One is obviously ROC. We know this. It's basically return generated per year for your capital employed. And so in this case, the capital employed doesn't mean only the equity capital. It obviously means debt, and debt includes long term and the working capital debt. So IRR. IRR is slightly different from ROC. ROC and IRR are not the same. The very important basic fundamental concept. ROC is the return that you make, the cash flow that you generate for the capital that you invest. IRR is the return that is generated by that business or a project over a period of time, over the life cycle of its entire project, basically. So general rule of thumb is IRR should be greater than your cost of capital if you want to select a project or continue with the project, etc. Asset, what you can sell or realize is asset, and terminal value. So value realized by the promoter of the business when it loses its continuity. When you want to finally sell your business, or you're running a cafe, and a cafe for various reasons you want to sell the cafe. What can you realize? You can probably sell the furniture for maybe 20% of the cost, or you can sell your coffee machine for 10% of the cost, and that is your final value that business basically gets. Very simple definition of terminal value. So I'm just quickly jumping into a couple of case studies in terms of these are all like live, real case studies. It's not a figment of one's imagination. So there'll be some numbers, but I will. You don't need to worry so much about the numbers. I'll just point to which are the numbers that you have to look at. So this is basically a distribution opportunity of a pan India multinational FMCG company. So this opportunity came to one of our existing clients, who ran it through us, and we were just looking at some of the basic things, right? Uh, so here, the opportunity is to become a distributor for a general trade, covering the Western Chennai region, which has about 600 general trade outlets, basically. So the multinational FMCG wants you to kind of sorry. So Uh, the multinational FMCG, let's take this particular call. The multinational FMCG wants you to invest about 1.25 crores for this particular venture. And this 1.25 crores includes about 19 days worth of their stock, which itself will come to around 1.16 crores. Then you have to pay some money for damages and claims and advance. And the entire investment amount is about 1.25 crores. Uh, for which the sales generated on a per month basis is about 1.6 crores. So if you generate a sales, so basically the business is where you hire a couple of people, and basically you go and take the orders from the general trade outlets for whatever products they want, and then you kind of generate the bills and send it to in this to the FMCG company, and the company will basically pay you 1.5% on the turnover. So which is about the turnover is expected to be about 1.6 crores. So 1.5% of 1.6 crores is about 2,40,000 rupees is what you will make on a monthly basis. And there's a small incentive that the company provides is about 56,000. So in all, you make a tad less than about 3 lakh rupees, uh, a month in terms of your turnover. So for which there is a some overheads which you incur. That is around 1.12 lakhs worth of overheads. So this 2,96,000 your turnover minus 1.12 lakhs, you are left with something like 1,83,000 or 1,84,000 per month. So which translates into a 1.5% return on investment on a monthly basis. So 1.5% per month, when you annualize it, is about 18% per year. Any thoughts on whether this is good or bad? Any is this good? You will invest. Please raise your hands. Good. So there are a few missing elements in this, right? So you rightly pointed out that the expenses were less, which is very right. This is what was projected by the multinational company. So the so basically, the implicit costs are not assumed. So obviously, when you are going to be involved in this business, there should be some reward for your effort. So you're going to handle about 1.5 crores worth of business every year, which means that either you handle it as an accountant or you have to hire a senior accountant, which will be about 60-70,000 rupees of extra money as salary that you have to incur. And over and above that, this is a 18%, which is a pre-tax kind of a return. So post-tax, when you knock off another 20-25%, the returns actually come down quite significantly. So, the thing is that the comparison is always made with the risk-free rate of return, whereas in reality, the comparison should be made with, your implicit costs must also be accounted for, which is the salary for the promoter, and you have to have inflation premium also adjusted into your overall calculation. So when you do this, the returns aren't very superior to a fixed deposit. So for all the effort that you make, the returns aren't that superior, but when the company shows it, it shows it like as if it's a very healthy double digit return. And this is, mind you, not accounting possible bad debts, etc., which you will incur in this business. Second case study is a very prominent restaurant chain in Chennai. So this restaurant chain is basically you know uh, invested about 11 crores, and they do a revenue of about 35 crores. The PAT margin is about 10 to 12%, and asset turn is about 3.2x. So you invest 11 crores in the business, sales is about 35 crores, your asset turn is 3.2x, and the ROE for this first restaurant is about 36%. So looking at the success of this restaurant actually set up another second restaurant uh, in the IT corridor in Chennai. And the capital deployed there was almost twice of the first restaurant, about 20 crores. And they expected a similar asset turn of 3.2x, which is 60 crores. Unfortunately, this particular restaurant is not doing more than 30 crores of turnover. So the second restaurant is actually making loss, and it is in turn getting funded by the first restaurant. So the point here is, when you run a self-run business, when in terms of growth, typically the assumption is that there won't be any reinvestment risk and there won't be any misallocation of capital. So just to give you a theoretical illustration, if you invest a 100 rupee principal and you make a 24% return, so that's a 24 is your final profit. So next year you reinvest the 24 back into the business. So 124. This 124 again earns 24% return. and then which is about 130. So you keep on doing that, your 100 becomes 293 at the end of 5 years, which is basically a 24%. The first year return is the same as the final return. So this is in a best world scenario where every reinvestment of yours becomes very successful. Whereas you know out of five decisions, if you were to make two mistakes, where you put up a restaurant in a wrong location, or something goes wrong, or the taste of the people in those locality don't are not really the same as the ones. Uh, I mean, for example, in Anna Nagar you can add onion and garlic. In Mylapore you can add onion and garlic. So all these subtleties are there, based on. So the first year same thing, 100 rupees, you generate 24% of return, so 124. So the next year, there is a assuming there is a 20 to 25% of misallocation of capital. So basically, what happens is that out of that 124, the 24 rupees of capital is not earning you anything, or basically there is a loss or something goes wrong, and therefore even at the end of second year, your capital remains at 124. And again, at third year, you make a small capital allocation mistake, and you do this. In the previous case, we saw that the 100 over here became 293 without any mistakes in reinvestment. So your ROE was 24%. Whereas in the second case, which is more practical case in the real world, you make two investment mistakes. You misallocated just 24% of your capital. So 100 becomes 188, which is our return of just 13.5%. So what looked very attractive in the first slide, your ROE is in fact halved in the second instance. So misallocation of capital is a huge risk in self-run. Can't we make the mistakes in equity market? Does all our 100, 20, 25 picks go right? Answer is no. Definitely, we also make mistakes, but there is a chance that you can easily exit the business with a loss, and maybe move on to the next idea, rather than being completely married to the uh, business. So if you go to rural Tamil Nadu, Madurai, next to Madurai, there is a current craze is this. Typically, you have these huge theaters, single screen theaters, which has a seating capacity of 1,000 to 1,200 people. The theater is very dilapidated and bad condition, and so on and so forth. So, people approach, and there is a proposal to convert it into multiple theaters. Typically, the current theater capacity is about 250 seats. They want to make the 1,000 seater into a 250 into 4 kind of a seater. Uh, so this was again a client who obtained this business model. So investment amount is about 16 crores, and the landowner is giving it on lease only for 10 years and not more than 10 years, basically. Seating capacity is 250 into 4,000, and the expected revenue is about 17 to 18 crores per year. And expected profit is about 2.5 to 3 crores, which is matching with, if you look at the numbers of PVR and Inox and all these people, assuming very similar occupancy levels, you're talking about a 2.5 to 3 crores in a theater business. So your expected ROCE is about 16 to 17%, which is again, a very healthy double digit, looking attractive at this point in time, because the comparison is obviously with, fixed deposit where your returns are about 7%. So at the end of the lease period, you have to transfer the asset back to the landowner. So for 10 years, you are earning about 16% on your money. That is what is being portrayed over here. Uh, so on the first look, 17, 18% ROC looks very attractive. And, it looks like a no-brainer. But the biggest missing element is terminal value. So what happens at the end of 10 years? You don't own anything. You have to give it back to the landowner. So it's very simple. IRR function is there on Excel. If you just use the IRR function on Excel, you will get the sum. So your first year, your cash outflow is 18 crores, and then for 10 years, every year you make about 3 crores of PAT. So the IRR actually drops to just about 10.6%. Whereas your ROC is about 17, 18%. Your IRR drops to about 10.6% without terminal value. Assuming there is terminal value, and after the end of 10 years, you will get back the money that you had invested in the beginning. which is about 18 crores. This money, if you receive it at the end of the 10th year, then the ROC, IRR jumps to about 16.7% because your initial cash outflow is about 18 crores. And then at the end of the 10th year, not only do you receive the 3 crores and you receive back that 18 crores. So this IRR over here is matching the initial ROCE that we showed you, which was about 17%. Terminal value plays a great role in determining the overall valuation of the business. Rather than getting attracted just by ROI and ROCE, it has to be seen in context of what will happen at the end of the business period. Terminal value is something that I mean, this is just an example of where you transfer the asset back to the owner, so you're left with nothing. But in real world, terminal value can get impacted due to many issues, right? So one is obviously technological dominance. You are in a business where technology has come and disrupted it in a very huge way. So your existing business becomes almost close to redundant. So that leads to discontinuity. You are unable to scale the business further. Sometimes next gen itself is not ready to kind of lead the business. So a person has SME, MSME business, but both the sons are in US or Canada or whatever, earning much more than what the business can generate. They don't want to come back here and struggle with it. So then again there is a terminal value issue because of that. Sometimes B2B2C can become B2C. So typically, if you look at FMCG in the distribution business, I think Sham will also agree that progressively what they have been incentivizing the distributors have only been coming down significantly, whether it is Unilever or Dabur or any FMCG giant. So what was once B2B2C is literally becoming a B2C with the intermediary getting squeezed big time. So there is a huge problem. So there are some of the aspects that has to be kept in mind. If you are sitting on huge gains in equities, you want to diversify by moving into some other business, or you have an existing business and you're caught between whether to put money in equity or kind of put infuse more capital into your existing business due to emotional reasons or due to various other reasons. These things have to be taken into consideration, which is your IRR and terminal value, which will really help you take much better decisions over, to lead you to better results over the next 5 to 10 years, basically. Uh, so there are certain reasons why self-run businesses were doing extremely well, even as recent as about 2004, 5, etc. So generally, the margins in many of these businesses were higher than what it was. Margins were higher about 15, 20 years back than what it was today. One thing is one of the there are several reasons for why the margins are compressing, which we all know. Most of the one is obviously the information asymmetry is dwindling, so everyone has a mobile phone and very low data connectivity, so everyone knows what is the price where, etc. So this was information asymmetry was an edge for certain businesses like broking, trading, wholesale paper, textile, yarn, etc. So that information asymmetry edge has actually dwindled quite significantly. Uh, Technology and sourcing gaps. So the current latest machinery is probably 15x the cost of what you installed 20 years back. And typically, self-run businesses don't have the habit of allocating money for depreciation, so everything is invariably spent. So when it comes to refurbishing the equipment and everything, there is very little equity capital. You have to only borrow, where again the business becomes a little unviable in such instances. Regulatory gap, of course. Earlier on, I don't want to elaborate much on this, but we all know how regulatory gap is getting plugged with the GST and tracking, etc. So that used to be an edge for small businesses at one point in time. So that is again that edge is slowly getting removed completely. Uh, so the self-run business was extremely profitable then, which is not the case now. So I mean the promoters could afford some mistakes then. So even if you make mistake in year one, by the third or fourth year you will either you can push volumes or whatever it is, and you can make back what you lost, which is very difficult this day and age. Yeah. So just to highlight on some data, right? So funding availability has also increased manifold. So if a business is making attractive margin, 20% plus kind of a margin, competition increases within no time, and market equilibrium is restored very, very fast. And one of the reasons is the funding availability. Earlier on, funding availabilities for SMEs and MSMEs was a great challenge. But today, you can see the growth of credit flow to MSME is almost basically doubled from 12 lakh crores to 20 lakh crores in not even less than a decade, and it's continuing to grow further with technology and more people wanting to fund these kind of businesses. But taxpayer base has also grown significantly. And of course, this is from Mr. Nandan Nilekani's presentation that has been going rounds over the last 3 4 days. This is an earlier point that I was making, that the cost of data has plummeted significantly and mobile phone penetration has gone up quite significantly. So, which means that even someone who's armed with the data has as much information as a trader would have. Uh, so when we launched what we call as a Smile Fund in Sundaram, and I was working under a guru of mine, a legendary fund manager called Anup Bhaskar. So during small cap, tracking small cap stocks, and if you have to listen to the conference calls, 90 to 95% of the participants in a small cap company conference call used to be mutual funds. We used to think that we are the dadas, we will only get the information, we will always have the information asymmetry edge and institutional investor and so on and so forth. Today, if I attend a small cap company conference call, 80 to 85% of the questions are actually asked by non-mutual fund personnel, either it's EMS or ultra high net worth individuals or retail investors or so on and so forth. So that information asymmetry which the institutions used to have has been dwindled due to regulatory changes and data penetration and people circulation of information. So yeah, so all this, right? So demonetization, increased compliance cost, which was not there earlier, and e-commerce again disrupting with their cash burn kind of model. So all this is leading to lesser opportunities for a regular self-run business to consistently earn money. So for the kind of money that they are earning 15, 20 years back, you have to put in at least 5x to 10x the effort to earn similar kind of money. Business change is not necessary only for smaller companies, right? So even the biggest of companies, there is always a business change and a value change. So then we can imagine what happens to self-run businesses, right? So if you look at the top 10 companies today versus the top 10 companies 10 years back, that itself there is a lot of change, right? So for example, uh, you had people like Sun Pharma, etc. 10 years back, the top 10 company. Today they're not even the top 10 company. Sun Pharma is not the top anymore. So there's a lot of churn in the value. This is the case for even some of the mightiest of businesses. I'm talking about blue chips companies which are part of the Nifty 50, etc. They are also seeing a significant churn over 5 years, 10 years, etc. The value keeps churning, etc. Uh, so for again self-run businesses, it could be even more brutal. So are all self-run businesses not wealth creators? So should you just completely shun self-run and move 100% to equity? Definitely, the answer is no. So we are not here to sing praises about equity and say that equity is the way. Equity has so many disadvantages. I mean, I'm very open about that. Uh, so there are certain instances in which you can continue to run your self-run business, or you can continue to explore self-run business opportunities. This is one such business. So when there is a visibility of 15 years, so if you feel that it's a sticky business and there is visibility of at least 15 years, there's now you can run the business comfortably, or there is a proper succession plans in place and so on and so forth. Now, if the business were to earn an ROC of 16 to 17%, then you can continue to do your self-run business because the IRR of the business after 15 years at 15% is very similar to the ROC of 16%. There's not much of change, so you can continue with self-run business in such instances where visibility is at least 15 years or more. But if you feel that the visibility is not 15 years, you can't run the business for more than 10 years, you're not able to see beyond 10 years, then in such instances, if the ROC is very high, then you can still consider self-run business. So what is the definition of high ROC? So the ROC is in excess of 20%, but the business visibility is available only for 10 years. Your IRR is still very decent, around 16.5% the end of 10 years. So if the ROC of your business is low, the visibility is 15 years or more, you can still do your self-run business. If the business visibility is just 10 years, your ROC is 20% plus, then you can still consider doing self-run business. But these scenarios are very, very rare. So as I mentioned that to earn 20% uh, for 10 years or to earn 15 to 16% over 15 years, those kind of businesses are it's becoming a rarity. So if it's a Me Too business, then one way of wealth creation is unlocking, right? So like for example, if you look at PVR, the market cap is 13,750 crores, and the PVR is doing this, right? Going to places and converting a single screen into four screens, five screens, etc. But the promoter has already unlocked the value. Mr. Ajay Bijli is owning only 27%, and more of he decides to if he says that enough is enough, I want to retire, he can sell the stake to somebody else for 4,000 crores. And so, value unlocking, if you're able to list your business or find a financial or a private equity, then self run business, and you can still. So, in terms of equity investing, what are the pros and cons? Right? So, I've just put the 10-year data. I've not even looked at anything long term. So, I understand that we are talking at an all time high level. So, the returns are looking slightly more glossier. Notwithstanding that, I'm not even talking about the benefit of active fund management, portfolio management. I only put the index. The index, this is what the index has done. So index, Nifty index, the top 50 companies in India has delivered a 14%, 13% CAGR without dividend. The Nifty index. A mid cap index has done something like a 17% CAGR, and small cap index has done about a 19% kind of a CAGR over a 10-year period. And of course, active managers of products from Sean Stable, significant alpha creation is there. In NAFA, in our emerging blue chip, we have been able to manage some alpha. Uh, so here again, when I talk, when you buy Nifty, when you buy an ETF or an index or whatever it is, you are indirectly owning 50 businesses. BSE 500 is about 500 businesses, and small cap, mid cap index is 150 businesses. So when you park your money in that, you are literally parking your money in 50 businesses. Right? So obviously it's diversified. No two ways about it. So even if one business were to kind of the Nifty also has undergone so many changes, so many things have happened. Nifty has had Yes Bank at one point in time. Nifty has had India Bulls Housing Finance at one point in time. So many accidents that have happened inside the Nifty itself. Notwithstanding that, Nifty has delivered 13% return. So uh, even if one or two businesses were to go kaput in the Nifty, uh, the rest 48 businesses are not going to go kaput, so they will still be able to deliver reasonable returns, or at least that's what the last 10-year data is showing. Uh, Nifty companies profitability, the growth is around 10 to 12%, whereas in BSE 500, the growth, in fact, the last quarter growth was about 15% for the NSE 500 companies in terms of profitability. So just to kind of conclude, so again, this is not a and or kind of a decision. So if you understand the business model correctly, then equity definitely becomes profitable over the long run if you can stomach the volatility. Uh, So value is what we get, price is what we pay. So just because you invest 50 lakhs or 1 crore in doing a interior for your cafe, or you buy 1 crore worth of machinery, that doesn't mean that at the end of 10 years, 15 years, somebody is going to pay you 50 lakhs or 1 crore of that money. It's definitely not going to be that much. So there is depreciation, there is terminal value which will come into play in such instances. So price is different and value is completely different. Uh, yeah. So willpower to hold on, discipline, and courage to exit and book the loss in some of your investments if it doesn't work will obviously lead to better results from equity investing point of view. Obviously, you can make a comparison and either increase equity, decrease equity, so on and so forth. So, just a quick case study. So, in the first thing, the FMCG distribution implicit cost was not assumed, which actually reduced the results. The second case study of restaurants, there was misallocation of capital. Second restaurant was not as profitable as the first, which pulled down the overall ROE of the total business. And mind you, in the second restaurant case, we have only assumed equity money. If you have borrowed, I'm not even gone into that. Third case is terminal value. So terminal value, this problem can occur not only for self-run business, it can occur even for listed businesses. So for example, at this point in time, market perceives that businesses like Castrol, Amar Raja, uh, Titan is a mistake. Ignore Titan. Castrol, Amar Raja, Jagran, Fashion are all considered as companies where there is a question mark over the sustenance of the business or terminal value. So, which is why that being an MNC for 1,000 crore of refit, Castrol is available at 12,000 crores of valuation. Similarly, Jagran, etc., single digit PE multiple. Uh, the two things possible, right? So one, if the business continues into its slow erosion, then the valuations are not going to get re-rated. But in the case of Titan, 20 years, 22 years back, we were considered as a watch company, and there was question marks over. Then they completely reinvented the business and went into jewelry, and the story is completely different today in terms of Titan. So these businesses in the listed space can reinvent themselves, or Castrol can become a relevant player in the EV space or in the industrial space, then market will re-rate these companies. Else, so the point is that terminal value is an issue even in the listed space. And so if that is the case, you can exit with a loss. So you don't need to get married to the business and move on to the next name. Whereas in a self-run business, that might be a little difficult. So a quick summary, like I mentioned, just to summarize what, if the ROC is 16% and business visibility is 15 years, you can go for self-run. The ROC is 24%, business visibility is 10 years, again self-run. But if the ROC is 16% and the business visibility is 10 years or less, then you move towards equity investing. With the ROC is 16%, then there's not much of fixed cost, existing business, trading business, etc. Self-run you can continue, but in the long run, you have to kind of look towards equity for wealth creation. 16%, it's a legacy business. Then incremental capital could definitely not go into the legacy business. It should move towards outside of the business, basically. Uh, Again, if it's a very volatile business, then equity is better. And if you can unlock the self-run business, then you can do that as well. Thank you for your time.